Hello class. This is recording 1 on stockholders equity basics and issuing of stock. The maximum number of shares of stock a corporation may issue is called authorized stock. This is the total number, the largest number that you'll see. It's how many shares are authorized by the state for each company, for each class of stock that they have. So this is the amount that they have available to be issued. Issued stock has been issued by the corporation out to the public. So it's the next, this is what we'll be going over issuing. Stock held by stockholders is called outstanding stock. Shareholders are issued stock certificates, and capital stock represents the stockholders' ownership. So this ring here, the largest outside ring, represents the amount of shares authorized, maximum number of shares that can be issued. So that's the total authorized from the state. Authorized and issued stock that has been issued but may or may not be held by stockholders. So these are stocks that have been issued. Okay, they've been, cash has been received and equity has been given. Stock shares have been given. And then the center is authorized, issued, and outstanding stock that is held by stockholders. This is what dividends are issued by. And the difference between these two, issued and outstanding, is the issued minus the treasury stock that we buy back. That would be authorized, issued, and outstanding. And this would be the amount of stock that we would be using to issue a dividend to. We cannot issue dividends to treasury stock that's owned by the company. So corporations issue different classes of stock. Common stock represents basic ownership. Preferred stock, which is rare, gives owners certain advantage over common stock, and we'll go over that soon. It's more like a loan than it is a stock. It has a dividend which must be given out, where dividends are not normally guaranteed, but preferred stock get their dividends before common stock. It's a fixed amount by a percentage of par, and it also goes away after a number of years, just similar to a loan. They do not have the benefit of voting on corporate issues. Common stock do have voting rights. Stocks may carry a par value or no par stock. A par value is a stated amount. These are the amounts that are the base given to a stock. It's not really what it's worth, but it tells us when we issue a par, when we divide the total amount of stock, common stock dollar amount by the par value, it'll tell us how many shares are issued. Stated value stock is a non-par stock, but it does have a value stated to it, which in itself will do the same as a par. Corporation's equity is called stockholders' equity. Two basic sources of stockholders' equity are paid-in capital. This is the amount that's paid in, similar to contributions. People pay in capital and they get stock shares in a sole proprietorship. This would have been an owner's contribution. And then retained earnings. This is a different form for us. Retained earnings is equity earned by profitable operations that is not distributed to stockholders. So it's basically your net income or net loss. It's kept in a separate account from contributions and net income or net loss. So this is a permanent account that separates paid-in capital and earnings that were retained from net income or net loss. Issuing common stock at a premium. Smart Touch Learning issues an additional 3,000 shares of $5 par for $5 per share. The $4 difference between the issue price, $5, and the par value, $1, is a premium recorded in paid-in capital excessive par. So here, the cash, the amount received, was at $5 per share. So the cash times the 3,000 shares comes out to $15,000. But we issue the common stock at $1 par. $1 per share times 3,000 shares, we're issuing at $3,000. And then we have a paid-in capital excessive par for the $4 difference. $4 per share times 3,000 shares is $12,000. So we have it issued. This is what we see when we issue at a premium. So we're issuing at par. We always issue at par. And anything that the stockholder pays in excess of par, they paid us $5 per share, so a $4 premium would go into paid-in capital excessive par. If we were to divide the amount that's in common stock by its par, it tells us how many shares are outstanding, which we need to know when we're issuing dividends. So we always issue at par or stated value. And this is what it looks like when we're issuing common stock at par value. Smart Touch Learning's common stock carries a par value of $1 per share, and the charter authorizes 20 million shares. Okay, so that's that large number we talked about. This is authorized. Shares of common stock. The stock issuance of $15,000 share, 15,000 shares of stock at par value is recorded as follows. So cash $15,000, common stock $1 par, 15,000 shares for $15,000. So this is what it looks like at par. The last one we looked at was at a premium. What happens when there's a premium? We use paid-in capital excessive par for the difference. And again, if I were to divide the amount here that's in the common stock account ledger by its par value, it tells me how many shares are issued. And this is what a partial balance sheet would look like after the two transactions that we did. We have Smart Touch Learning, balance sheet partial, December 31st, 2025, stockholders' equity, paid-in capital. Common stock, $1 par value, 20 million shares authorized, 18,000 shares issued and outstanding. So at par, it's $18,000. We divide by par, it tells us how many shares are outstanding. Paid-in capital excessive par, this $12,000 was the premium. So total paid-in capital, $30,000. And then we list the retained earnings separately. Okay, what's in that account from net income. And the following is an example of no par common stock. So they issued 15,000 shares for $1 and 3,000 shares for $5, both coming out to $15,000 each. And this, you'll notice that we won't be able to figure out how many shares are outstanding this way because even though we have it listed here, 18,000 shares, there'll be no par to divide it by. So when we see it on the balance sheet, here it's just showing common stock, no par value, 20 million shares authorized, 18,000 shares issued and outstanding. They're giving it to us here, but we wouldn't be able to calculate that. Because there's no par. $30,000 total, there's no paid-in capital excessive par, and then retained earnings. And here's stated value common stock. Okay, when they're giving you a stated value, in this case we'd be able to check to see how many shares are outstanding by the stated value, which is very similar to the par. So Smart Touch Learning issues 3,000 shares of $1 stated value common stock for $5 per share. Accounting for stated value common stock is similar to as accounting for par value stock. So $5 per share times 3,000 shares is $15,000. Common stock, that's the cash common stock. Credit is $1 stated value, so $1 times the 3,000 shares. So that's at stated value, 3,000, and paid-in capital excessive stated value, $4 premium times the 3,000 shares, or $12,000 in paid-in capital excessive stated. And then there's also preferred stock. We look at preferred stock. Again, it's issued, it's a stock, but it's very similar to a loan. So Smart Touch Learning issues 1,000 shares of its $50 par, 6% preferred stock on January 3rd at $55 per share. Okay, so we're seeing a $5 per share premium. Okay, so cash is going to be the $55 per share times 1,000 shares. It's going to be debited cash for $55,000. Preferred stock, $50 par value, $50 per share times 1,000 shares. So it's $50,000 at par. Then paid in capital excessive par preferred stock, $5 per share times 1,000 shares for the $5,000 paid in capital and excessive par. We also can issue common stock for assets other than cash. In this case, we exchanged 5,000 shares of its $1 common stock for furniture with a market value of $18,000. So in this case, we bought furniture for $18,000, and we issued 5,000 shares of common stock at $1 per share par. So it was $5,000 for a common stock at par, and we also, the difference between the two is $13,000. That's paid in capital excessive par because it was a premium. So we'd also have paid in capital excessive par common, 18,000 minus the 5,000 for 13,000 for the furniture. So we can issue stock at fair value, the fair value of the item, the asset, in this case office furniture, at par. So here's a partial balance sheet at the end of our last few journal entries. So we have paid in capital preferred stock, $50 par value, 2,000 shares authorized, 1,000 shares issued and outstanding, $50,000. Paid in capital excessive par preferred, $5,000. Then we have common stock, $1 par value, $20 million shares authorized, 23,000 shares issued and outstanding, $23,000. Paid in capital excessive par common, $25,000. Total paid in capital, $103,000 with retained earnings from net income at $3,550 for total stockholders' equity of $106,550.